natural gas, it is soaring today. You can see it's up over 18%. It's up 50% this year, and that puts it on pace for its best year since all the way back in 2016. Speaking of 2016, Joe, you have some exposure here, EQT.
Yes, I'm going to continue to talk about natural gas as the fuel in the energy sector that investors and our viewers should be focusing on in 2025. I truly believe that's where the opportunity is. I think in terms of existing inventories, we're beginning to work off excess supply. Now you have a colder than anticipated weather forecast over the next 15 days. In addition to that, remember that natural gas offers the solution in terms of power generation for all of the utilities that have this insatiable demand coming from data centers, and they're partnering with the mega cap companies like we saw with Microsoft, 3 Mile Island, and Constellation Energy. So natural gas is the solution in that formula in terms of providing power generation. I think natural gas in 25 should be an investor focus. All
right, natural gas hitting a 52-week high today. Brent, I want to come over to you. You have a lot of broad energy ownership, Energy Transfer, Diamondback, Viper as well. I just want to see how you see the energy trade overall when it comes to this month and going into 2025.
Yeah, well, so we talked about the strength in the dollar. Obviously, that in energy materials is a really big headwind. I think in this space, you really got to pick your spots. I mean, we see Energy Transfer up there. Energy Transfer is a pipeline like Kinder Morgan. Energy Transfer and Kinder are up like 45 and 55% year to date. Energy Transfer also is like a 7% distribution yield. I also like the mineral right companies, which are very cap light, like a Viper Energy, up almost 60% year to date. And so I think you really have to pick your spots. You know, I sold Devon earlier in the quarter. It's just been an underperformer for a couple of years, relative or on an absolute basis. And so I think stay capital light, stay in the toll road of hydrocarbons, which are the pipelines, and I think that will be another good year for both sectors, subsectors within energy.
Okay, Rob, I want to come over to you. You're looking at energy as a hedge to geopolitical risk. You have to explain that because we've seen geopolitical risk rise and the oil market still trade lower. In fact, for a lot of the year, WTI below $70 a barrel.
Ignored it. There's no question. I think that's a little bit of a signal from the markets that there might be some worries about growth coming. But no question that they have historically been a great hedge against geopolitical tensions, against upside surprises in inflation. I think the key story here is the companies are more efficient operators and capital allocators. They're focused also on returning cash to shareholders. Valuation is reasonable, but the big question for energy is how much do they deteriorate if economic growth deteriorates, causing prices to break below? And so far, we've seen lower prices support consumption. But what happens with growth? So, you know, we have a diversified basket. It trades at 12 times earnings. We're very excited about that. I think it's an overweight for us, and it's a place that, you know, acts as this barbell hedge with potentially some economic leverage.
All right, WTI is up almost 5% month to date.